And we are going to discuss today about float, right? Understanding float. What is float? In simple terms, you might study it in accounting, in basic accounting, financial accounting. You have prepared cash book, isn't it? Cash book. Mainly there are two columns: cash balance and bank balance, debit side and credit side. And consequently, you have studied bank reconciliation statement. That statement is mainly prepared to reconcile balance. Uh, Most of the times, the bank balance in the cash book and the bank balance in the bank statement are differ due to various reasons. So, an accountant should reconcile that account, the balances, cash account to bank account, so bank balance to cash balance to bank balance, right? So there are some procedures. So why the differences arise? You have no. So what are the reason behind it? So that what we are going to discuss. How do we manage the differences? Plot. So what is plot? The difference between book cash and bank cash. Book cash and bank cash, representing the net effect of checks in process of being cleared, right? The major cause for that difference is check payment. Checks are in the process, right? So types of plots. There are mainly two plots. First one is a disbursement plot. Disbursement. So when we uh, make payment through checks, we are encountered with disbursement plot. The result of checks written decreases the book balance but does not immediately change available balance. It means if you are a accountant, if you write a check for your supplier or any payable, at the time of you write the check, you deduct your bank balance, in your cash book, and the supplier takes time to deposit that check in their account. Subsequently, the bank balance in the bank does not represent our actual balance in our cash book. So that's called disbursement plot. So it is arises mainly to the payment by check. And the collection plot mean we receive check from our customers, and when we receive the check, we insert insert the insert in a cash book. We have received cash book cash in the bank column, but when we deposit the check, banks take time to clear, meaning to credit your bank account. So due to that delay, your cash book balance and bank book balance will be differ. So this is called collection fraud. The result of checks received increases book balance but does not immediately change available balance in the bank, right? Net floats, it means the overall difference between firm's available balance and its book balance. It's a net float, right? So during the period, you may receive so many checks and also pay many checks. So there are a lot of deviations. So we get all the deviations together and we find a net float, the overall difference between the firm's balance and the book balance regarding the uh, cash balance at bank. And float management. So financial manager or accountant You have to efficiently manage this kind of floats, delay, right? In other words, we can say delay, right? Objective of float management. In cash collection, if you are in the position to collect the checks, so you have to speed up check collection. You have to speed up the check collection, and it's a reduced float components, right? It's one of the component of float. We will discuss it. And in case disbursement, in case of payment, we have to control our payments, and it's minimize cost. We have to work both sides, control payment as well as we have to minimize cost. If you are able to cut the cost, that is your efficiency. Increase the float component, right? So cash collection, you have to take more efforts to collect cash speedily, then it will help to reduce the float, and also at the same time you have to increase your float component by way of cash disbursement. And the components of floats. Number one, mail float. Number two, processing float. Number three, availability float. Mail float mean your customer sent your check by post, via post, right? Via post, they have sent your check. Due to various reasons, you are unable to get that checks on time. For example, due to COVID-19, sometimes the postal department works slowly. The post office are under the lockdown area. So due to that reasons, the delivery of your checks to your office may be get late. Right? So this is called made fraud. The same thing will happen when you make payment by check. If you send you a check by post, it takes some time to deliver that check to your supplier. So this mean mail fraud mean check trapped in postal system, trapped in postal system, and processing fraud. So until receiver of checks deposit the checks, right? Until receiver of checks deposit the checks, and availability fraud. So until check is clear in the banking system. Uh, Once you receive the check, and also you will take some time to deposit the check into the bank. You receive the check, and you have take a time to bring the check to the bank. That is processing fraud. And availability fraud, once you deposit the check, the bank also take time to clear your check in the bank. And the total fraud, total time delay, total fraud equal mail fraud, processing fraud, and availability fraud, right? Equal total time delay or total fraud. If you are an efficient manager, you have to minimize the fraud, total fraud. Now, how do we measure fraud? Measuring and costing the fraud. How do we measure it? So we can find the average daily fraud. How? Take total fraud. It includes all mailing fraud, processing fraud, and clearance fraud, availability fraud, right? Divided by total days, total number of days. Or average daily fraud equal average daily receipts into weighted average delay. There are two formulas. So the cost of collection fraud, the cost of collection fraud to the firm equal opportunity cost from not being able to use the cash, right? So for example, one of your customer has sent a check rupees 1 million rupees. He has posted 1 million rupees today, and he is situated in, so for example, in Colombo, that is in lockdown area. Due to the lockdown, you are unable to receive your check. right? It may take 1 month or 14 days whatsoever based on the situation. So this time you are unable to get the benefit of from that check, that money. So, so this kind of loss opportunity cost equal the cost of collection plot of the firm, right? You are unable to use that money. So due to that, you may encounter some potential benefits. You will lose your potential benefit and returns. And how do we manage float? Managing the float. Right, first one is factoring. Factoring mean we sell our customer to third party, to other people or to other organization. So for example, you are going to receive 1 million from your customer, uh, and the payment will you will receive after 3 months. What you do is you don't need to wait up to 3 months, and you can sell your customers receivables to the bank, and immediately you will get some amount of money. So for example, for 1 million, you can get 800,000. Instead of 1 million, you can get 800,000. 2 million, sorry, 200,000 may be profit for the organization which buy the customers from you. Factoring, the selling of receivable to a financial institution. The factor, usually without recourse. So if there are any uh, unclaimable receivables, it is not your risk, right? The institute which purchase your receivable factor take that risk. And credit insurance. Sometimes your customers unable to settle your dues, right? Then uh, to avoid that kind of risk, you can make insurance, right? Credit insurance. It's protection against the risk of bad debt losses. It's protection against the risk of bad debt losses. And you can delay disbursement. You can delay the payment. So it increases the disbursement float, right? That's another way, other way around. And investing idle cash, right? Investing idle cash. So when you uh, doing business, sometimes you may have surplus money, which money is not contributing to make profit. So the temporary cash surpluses can be invested in marketable securities. So you can deposit, no, you can buy treasury bills, 90 days, 60 days treasury bills. You can uh, buy if you have surplus money. And if you are encounter with a cash deficit, you want more money to run your business, you can sell the marketable securities which you already purchased. Sell marketable securities, or we can go for a bank and get bank overdraft, short-term financing option, bank overdraft. And if we have a temporary surplus or deficit, the result of is the cause of seasonal or cyclical activities. Right? Right, if you are facing a case deficit, it means you are in the season. No, there are big demand you encounter. Then that time you need more working capital, more money to buy more inventories, and you have to give more credit terms. You have to extend your credit terms to your customers. So that time you need more money. And planned or possible expenditure. For the purpose of spending expenditure, you are accumulating expenditures, right? You are accumulating the expenditure for the future expenditures, planned expenditure. And the securities market, how we can use securities market to utilize idle cash. If we have temporary cash surplus, so we can go for uh, securities market where you can buy
incarnate.
Right? If you go to securities market, you can buy future and options, you can buy shares, and you can invest in your long-term debt markets and the short-term money markets, foreign exchange market. There are markets, and you can invest your money. And where you can find financial intermediaries. For example, the underwriters and stock brokers. So you have to deal with them to make an investment in securities market. And short-term securities. So what are the characteristics of short-term securities? In terms of maturity, is less, 90 days, 60 days, 30 days. Maturity is usually less than 90 days. Investments then avoid interest rate risk but have low return. When we compare the maturity for the long term and short term, right? The return of for the short term securities providing less amount of return, but the long term investment will give you high amount of return, high rate of return. Right? Compare 3-month fixed deposit and 5-year fixed deposit interest rate. Normally banks will give you high interest rate for your long-term investments maturity. And default risk mean the credit worthiness of creditors. If you have surplus money, better option is you buy the government securities, right, treasury bills, because it has less risk. So idle case generally invested in less risky securities, say government issues, government treasury bills, and marketability, high liquid assets. If we have surplus fund in the short run, we can buy a financial instrument which would marketable easily, market easy, right? Whenever we want money, it is possible to sell the instrument very quickly without losing money. Marketability. The idle fund usually invested in highly liquid securities. If you purchase stocks in the share market of listed companies, then whenever you want money, you can sell the shares and can get money back. And investing cash. Uh, Temporary cash surplus. If you have extra money, cash surplus, so it is arises due to seasonal or cyclical activities. This time you buy marketable securities with seasonal surplus. Convert the securities back to cash when you encounter with deficit, right? And planned or possible expenditure, it is accumulate marketable securities in anticipation with the expectation of upcoming expenses. Right. This is pictures. It's explaining the financing, seasonal and cyclical activities. In the vertical axis, they plot cash needs, and the horizontal axis the time period. As we discussed in earlier about working capital financing, there are three, right? So this one here. So what kind of policies? In the middle, no, not aggressive, not conservative. Right, it's matching, no, right. When you look at here, right, the colored one is what the total financing needs. The total financing needs is divided into two: the short-term financing and long-term financing. right? It's like aggressive, no? It's like an aggressive, not aggressive. It's what? It is matching concept, right? It is matching. Here, when you see the time period one, you have extra money, right? Your requirement is here, but you are having this amount. So you have surplus money. So what you can do is you buy marketable securities. You can buy marketable securities. And when you see the time period 2 here, you have money at this point, but the requirement is higher point than that. Then this time you can go for, you can sell your marketable securities, or you can go for bank or other short-term financing sources, say bank overdraft and so on. Here the Taiwan, a surplus cash flow exists. Seasonal demand for assets is low. So the surplus cash flow is invested in short-term marketable securities. And the time 2, a deficit cash flow exists. Seasonal demand for asset is high. Therefore, the financial deficit is financed by selling marketable securities and by bank borrowing, especially bank overdraft. Now we move to the new section, right? We have finished cash management. Now we move to another sector, that is credit management, credit and inventory management. The first part of this chapter will focus on credit management, and second part of this chapter will look at on inventory management. Right, the credit management, the key concepts of credit management. Understand the key issues related to credit management, and understand the impact of cash discount, and be able to evaluate the proposed credit policy, and understand the credit component of credit analysis. In inventory management, the key concepts are understand the major component of inventory management and be able to use EOQ model, economic order quantity model, to determine optimal inventory level. I think the key issues, right? The credit management key issues. First, when we expand our credit to our customers, for example, at present, you make sales only by cash. In your shop, there is no credit sales. Now you have decided to make sales on credit terms, credit basis. Definitely, you can increase your sales. Definitely, you can increase your sales. That is a plus side. But it has another side. It's cost of granting credit. Cost of granting credit. So when you give credit to your customers, the chances that customers won't pay. Sometimes they are not willing to settle the credit, and also you have to financing receivable, right? Your customer will pay the money later period. Until that, you can't be an idle, right? And you have to finance, you have to put money by your pocket, right? So you need additional working capital to manage your receivable. You have to wait until your receivables are cashable. You have to have some sort of money to run your business. And the credit management examines the trade-off between increased sales and cost of granting credit, right? Two sides, plus and minus. If you allow credit sales, you are we can expect more sales. But at the same time, you have to you will face a cash deficit sort of money, and sometimes your customers will unable to pay your credit. And what are the components of credit policy? Components of credit policy. The term of sales. The first component, terms. Term of sales mean credit period. How long, how many days you are allowing your customers to settle your money. Say for example, a customer purchased from you on 1st of January 2021, and if you give you 30 days credit period, and he will give the money to you on 31st January 2021. That is credit period. Cash discount and discount period. Say your standard period is 30 days. This means your customers should settle the money within 30 days. To encourage your customers to pay early, you can give cash discount. Say normal period is 30. Anyhow, if any customer settle that money within 30 days, within 10 days, in 10 days we can give them 2% discount. It's called cash discount. And type of credit instrument. Right. Then credit analysis. Credit analysis is a distinguishing between the good customers that will pay and bad customers that will default. Right. So you have to identify who are the good customers, who are the bad customers. Good customers will pay money on time, use on time. The bad customers, sometimes they extend the credit period, they requesting for extending credit period, or they fail to pay your credit. In collection policy, effort expanded on collecting receivables. Some organizations uh, will get serious efforts. Some companies will give some flexibility, right? So if you are following very rigid rules, rigid policies, you will lose your customers. And if you are more flexible, you will the many customers will not pay money. So you have to be in the middle. Here the cash flows from granting credit. When you make credit sales, you have to process 3 steps. Credit sales, and you have to wait some period of time to uh, the customers will post your check, mail your check. Once they mail you a check, again you have to wait until you receive the check. Again, you have to wait to deposit that check, and finally you will end up with cash. Right? When you make credit sales, you will a new account will open, that is account receivable. Right? If you make your sales on cash basis, you don't have this thing, cash receivables. Right? There is no cash receivable when you make sales on cash basis. The account receivable arises when you make sales on credit terms. And term of sales, as you explained earlier, here uh, basic form, right? Here 210 net 45, 210 net 45. It means a customer should settle their dues within 45 days. This 45 days is standard, right? To motivate our customers to settle their money on early, we pay discount. We allow discount. Discount here 2% to whom? Those who settle the money within 10 days. That's the meaning, right? So meaning of this, 2% discount if they settle within 10 days, right? 2% discount if they paid the money within 10 days. Or if they fail to settle the money within 10 days, not exceeding 45 days, there is no discount, right? So for example, uh, buy 500 worth of merchandise with the credit terms given above. This term 2, 10, net 45. Which means if a customer give you the money within 10 days, how much they will give you? So original amount is 500. You promise them 2% discount if they settle within 10 days. So therefore 98%, no? 98% of, you will receive 98% of your original amount. That is equal 490. And if the person, if the customer not paid within 10 days, you will definitely will get 500,000 if they paid. And the credit policy effects, credit policy effect. As I told you, it has, when you make sales on credit terms, it has two sides, plus and minus, right? Plus side is you can increase your sales, and the negative sides you have to find, you will end up with some cost, opportunity cost of keeping money, opportunities of keeping money versus opportunity cost of receivable, right? And revenue effect. So in the revenue sales side, delaying in receiving cash from sales, and maybe able to increase price. So when you make, so you can have two options, cash sales and credit sales. When you buy product on cash basis, the you can you can give discount, you know. But if customers doesn't have enough money to pay the time of delivery, you can demand from them, and you can fix the price at higher level than cash price, and it may increase total sales. That is a revenue effect. And the cost side, cost effect, the cost of the sales is still incurred even though the cash from the sales has not been received. You have to wait. The cost of sale is still incurred even though the cash from the sale has not been received. So you have sold 1 million value of 1 million worth value of inventories to your customer, and he promised you he will settle the money within 6 months. So what will happen if we are unable to settle the money within 6 months? You will lose your value of inventory, 1 million value of inventory. And cost of debt, you must finance receivables, right? If you if you sell your inventories, your items to your customers, and you have to wait some period of time to receive your money from them, right? If you grant 30 days, so again you need money to buy inventories to satisfy other customers. Probability of non-payment, sometimes they are not paying. Some percentage of customers will not pay for product purchase. This kind of cost will not incur in case of cash sales and cash discount. And some customers will pay early and pay less than the full sales price. Even though you make sales on credit terms, some customers will expect some discounts to settle their money on early. And the total cost of granting credit, what are the costs? So as right, cash management and inventory management, it has two kind of cost. One is carrying cost, second one is shortage cost. If you have excess amount of credit it will incur carrying cost. It has a positive relationship, no? When we increase the amount of receivable, we have the, we have to increase our carrying cost. It will cost higher in carrying cost. So required rate of return on receivable will increase, and loss of bad debt will increase. Losses from bad debt will increase, and cost of managing credit in collection will be increases when you make more credit sales. And shortage cost. I mean, if you are not go for credit sales, you have to lose your many customers. It will finally lose sales due to restrictive credit policy. So total cost include both carrying cost and shortage cost. The sum of carrying cost and shortage cost equal total cost. The total cost curve has two things: sum of carrying cost and shortage cost. Optimum credit policy is where the total cost is minimum, isn't it? The optimum credit policy is where the total cost curve is minimized. Same principle as we used in inventory management and cash management. Carrying cost and shortage cost. Here, see the figure. So the blue line. In the vertical axis, we have taken cost, and the horizontal axis, we have taken amount of credit extended, credit sales. Here, when we extend our credit period and credit sales, what will happen? The carrying cost will increase. It has a positive relationship between the carrying cost and the carrying cost and the amount of credit extended. And when we follow very rigid credit policy, we have to lose our customer, and the profit from that customer we have to forego. So that kind of cost called opportunity cost, right? It has a negative relationship. Here the total cost equal carrying cost plus opportunity cost. Here this is the point where the total cost has minimized, and also at that point carrying cost equal opportunity cost. The carrying costs are the cash flows that must be incurred when credit is granted. They are positively related to the amount of credit extended. Opportunity costs are the lost sales resulting from refusing credit, and these costs go down when credit is granted, right? So opportunity cost. And credit analysis. Credit analysis. Credit analysis means the process of deciding which customers receive credit. We can't give credit to all customers. Before granting credit, we have to analyze, we have to study about your customers. We have to evaluate their credit worthiness. We have to decide whether they are good customers or bad customers. Gathering information. Do how do companies, organizations gather information about creditors, customers who are requesting on credit basis? First one, the financial statement. You can get the financial statement and you can study about their credit worthiness. And credit report, it's a past report, right? And payment history with the firm, and credit report with the other firms, and banks, the bank's opinion on their customers from the bank you can take. And you can determine the credit worthiness using 5 C's of credit. 5 C's of credit and credit scoring. Here, like when we download software, we can put 5-star, 3-star, 4-star like that. We can give some star, right? 5-star, 5-star customers, 2-star customers like that. Good customers will have 5 star, and bad customers sometimes 0 stars. Right. How value our credit sales, right? So economic benefits is evaluated through NPV, net profit, net present value, right? So when we calculate net present value, mainly the two things: cash inflow and cash outflow. Cash inflow and cash outflow. To convert the future values into present value, we need a discount factor, right? Here, the first part of this equation, V, right? It's what? Variable cost. V is the variable or marginal cost, and P is the price, selling price, right? And R is required rate of return. To get here, this is minus V is what? It's a cash outflow, it's a cost. P is a revenue, isn't it? P is the revenue, receivable, right? From that, there are some customers, they are not pay, they are not settled their dues. So it's a loss, and we have to make some provisions. We have to deduct that kind of expected bad debts from our revenue, right? And finally, we have to convert all the values into present value. So we have to use a discounting factor, that is R. Your company is considering a granting credit to a new customer. The variable cost per unit is 50. Variable cost is 50. That means minus V is 50. And the current price, selling price 110. The probability of default is 15%. And the monthly required return is 1%. So when R equal 1. So we can do it using the Excel sheet. We do it in Excel. Can you see the Excel sheet? Can you see? Is it visible to you?
No, sir.
Now can you see now?
Yes, sir. Now it is visible.
Okay. We know to calculate NPV, we need cash flow. We need cash flow. So that is first one, the margin. How much price? Variable cost 50, no? 50. And cash inflow. This is cash inflow. This is cash outflow and cash inflow. Cash inflow, how much selling price? 110 rupees. 110, right? 110. And from this 110, so there's a chance that 1% of our customers, 1% of our customers will not able to settle the money. So that is equal how much? 1%, you know, bad debt. Bad debt is 1%. 1% or 10%, how much? Um, so 15%, no? It's 15%. Bad debt is 15%. And bad debt 15%, and the required rate of return is 1%. Now we will find the NPV, right? So it is cash outflow, it's a minus, no? Minus 50. We take it. And cash inflow, so our expected revenue is 110. Out of this 110, 15% of customers will not settle our money. So therefore, it is equal 110, 1 minus this one. 0.15. Where is that? 93.5, right? And what's the net cash flow? Net cash flow, well, this 40 net cash flow. Net cash flow is 43.5. Then NPV, net present value, equal, we have to take this value, should be divided by 1 plus 0.01. It's equal, what's the value of value? 43.06. The value of our credit sales is 43.06, right? Clear? Right. So your company's now NPV is 40. Right, 43.57. What's wrong here? Okay, no? What's wrong here? Anyhow, right? 1.15 divided by 1.01. Right. Um, let's see. Net cash flow 93 points. As 43.52. But I think the exact calculation is this one, no? 43.6. No? Right, that's not an issue. Right. NPV is 43.57 or 43, correct, right? And what is the break-even point or probability? So what's the IRR here? IRR mean what? NPV equals 0. NPV equal to 0, and we have to find here the bad debt. So when we calculate using mathematical functions or IRR method, we can find this value equal 54.09. So it is not necessary for here from at here, but anyhow, so the understanding of how to calculate NPV is important here, right? What will happen? Repeat. If you repeat our customers, repeat. So we make sales on credit. We make sales on credit. Again, credit. Repeatedly for the same customer, we do it again and again. We do again and again. What will happen? Here, same thing. So only change is here R. Earlier we have used 1 plus R. Now it's become R because of perpetuity in nature, right? Perpetuity in nature. You might study it in valuation of stocks, right? Valuation of stock, you might study it. No, when the N become a large value, infinitive, then it's equal to R. When you make repeatedly, so what will happen? Look at the previous example. What is the NPV if we are looking at repeat business on credit term? Okay, it's the same as a cost, right? And also in this equation we have to deduct this variable cost from the sales revenue, because right, and 50 here is equal marginal cost, variable cost, plus and we have to deduct the the bad debts provisions, probability of bad debt in the revenue. And here it's become to find out the contribution. Actually the contribution is the profit contribution, sales price minus variable cost, it's equal to contribution, and divided by 0.06. Earlier we have divided it by 1.01. Due to the perpetual in nature, it's become 0.01. So when we solve this, the value of our customer is 5,050. So it reveals that, right? It reveals that, so credit sales become more valuable to our customers. Repeat customers can be very valuable. Hence, the importance of the good customer service, right? It means you have to uh, handle your customers with care, right? And it may make sense to grant credit to almost everyone once, right? As long as the variable cost is low relative to the price. The contribution here, the contribution is mainly depends on your marginal variable cost, a variable cost, right? If a customer defaults once, if the customer fails to pay certain your money, you don't grant credit again, right? Then where we can get credit information? So as we discussed earlier, we can get information from financial statement of their organization, customers, and credit report with customers' payment history. Other firms, if the customers are new to you, we can get the background information from other organizations they are dealing with, and the banks and payment history with your company. If the customers your existing one, then you can get information from in your company. So what are the 5 C's of credit? 5 C's, like 4 P's of marketing. We have 5 C's in credit. So number one, character of the customer, willingness to meet financial obligations, right? Willingness to meet financial obligations. Capacity, do your customer having financial strength, ability to meet financial obligation out of operating cash flows. Capital, reserves, capital reserves. Collateral, asset pledged as security, assets pledged as security. And conditions, general economic condition related to customer business. These are the 5 C's of credit. And credit policy is another most important area where we have a lot of calculations. And also it takes more time. Now the time is 1 hour, so almost finish, and we will continue in the next class. Meanwhile, I will put you an attendance link. Please mark your attendance through that link. Please be so please see your chat box. Please mark your attendance. And if you have any doubt, meanwhile you can ask. Okay, once you fill the attendance sheet, you may leave.